In this video, you'll learn the 5 best investments for anyone in their 20s to make. When you hit your 20s, don't we all dream big about money and being financially free? It's awesome to have that drive. But with the way living costs are shooting up, it's super important to be smart about where you put your money. If not, those big money dreams might just stay dreams. So in this video, we're going to talk about 5 investments that look pretty promising, and just heads up, starting early in the investment journey can make all the difference. So buckle up and enjoy. Number 5, money market funds. Mutual funds, specifically money market funds, are among the safest investment options available. They often yield higher returns compared to most traditional bank savings accounts. When scouting for a suitable money market fund, it's essential to scrutinize the fund's expense ratio. A lower expense ratio typically translates to better returns, as it indicates the fund's operating costs. For those in higher tax brackets due to substantial salaries, tax-free money market funds might be an attractive option. However, if you're not anticipating any urgent financial needs, you might want to explore treasury bills or bank certificates of deposit, commonly referred to as CDs. Banks usually offer CDs with terms spanning from 3 to 12 months. One drawback of treasury bills and CDs is the substantial transaction fees when accessing your funds. Moreover, early withdrawals from these investments before their term completion can incur penalties. But if you're able to commit your funds for the entire term, both treasury bills and CDs can offer returns surpassing those of standard savings accounts. But keep in mind that it's always important to weigh the pros and cons based on your financial situation and goals. So before we continue, I'd like to thank Aura for sponsoring this video. Have you ever Googled yourself and were shocked to find your personal information exposed on one of those public listing sites? Did you know you can literally Google just about anyone and find all sorts of private information about them? I'm talking about personal things like their address, phone number, and email addresses. And guess what? Your personal and family information is out there too. You see, data brokers, the guys collecting your private information, are making a fortune selling your information to robocaller, spammers, and others who want to learn more about you, like where you live, shop, and so on. Luckily, Aura, the sponsor of this video, can identify data brokers exposing your information and submit opt-out requests on your behalf. You see, brokers are legally required to remove your information if you ask them to. The problem is, they make it super hard to do. So let Aura handle it for you. On top of that, Aura also does so much more to protect you and your family from online threats you can't see. It's really easy to set up, so you don't have to download several different apps to get things like parental controls, antivirus, VPN, password management, identity theft insurance, and more. You get everything at one affordable price. So let Aura do the hard work of keeping you safe online so you can focus on other tasks with peace of mind. Now, you can either let people continue to exploit and profit off your private information, or you can go to aura.com/practicalwisdom to start your 2-week free trial. The link is in the description and comment section. Number 4, bonds. When you invest in bonds, you typically anticipate higher returns compared to what you get from a money market or savings account. This is due to the elevated risks tied to bonds. For instance, some corporate bond issuers might not repay the full borrowed amount, often because of unexpected financial hurdles. And just like you have a credit score, governments and corporations have one too. Those with a lower credit rating tends to offer higher returns, but they are more risky, and those with a lower credit score offer lower returns, but are much safer. Now that you know that, this is how bonds work. When you buy a bond, you're essentially lending your money to the bond's issuer for a set period. These issuers are usually governments or corporations. If a government defaults or a corporation goes under, there's a chance you might not get your money back. Given this risk, bonds, especially those with lower credit ratings, tend to offer higher returns. Jeremy Siegel, a renowned finance professor at the University of Pennsylvania, who has analyzed bond performance over 2 decades, states that bond investors typically see an average annual return of around 4 to 5%. However, factors like inflation and economic downturns can cause these returns to fluctuate. For instance, if a government bond offers a 4% interest rate when inflation is at 2%, an investor would effectively get a real return of 2% after accounting for inflation. But if inflation unexpectedly jumps to 6%, the bond becomes less attractive and its real return diminishes. Generally, long-term bonds yield higher returns than short-term ones due to the extended risk over time. Yet, it's worth noting that longer-term bonds come with their own set of challenges. Their credit quality might deteriorate over time, increasing the default risk. Moreover, they're more susceptible to inflationary impacts than their shorter-term counterparts. Hence, while they might offer higher returns, the associated risks need careful consideration. Number 3, stocks. Investing in stocks doesn't require you to be a financial genius. Anyone can do it, and you can even invest in stocks using your phone or computer. When you start investing in the stock market and consistently put your money into reputable companies and funds, you can see substantial returns. However, it's essential to remember that not every stock or fund you invest in is guaranteed to appreciate. Interestingly, stock returns tend to be more stable than bonds over the long term. Historically, the returns from stocks have remained relatively consistent across generations. For example, since the early 1800s, the US stock market has consistently delivered an average annual return of around 6 to 7% above inflation. This consistent performance is quite impressive, especially when viewed as an average annual return, but it's also important to note the volatile nature of stocks. They can sometimes face significant downturns, dropping by 30% or even more in a short span. On the flip side, they can also see rapid surges in value. Additionally, while the past performance of the stock market provides insights, it's essential to approach future investments with research and caution, as market dynamics can change. Now that you know that, here's how you make money with the stock market. There are 2 main strategies to winning with stocks. 1, keep investing regularly, and 2, think long-term. And here's a pro tip. Don't just focus on one country. Try and go global with your investments, as this can spread out the risk and often gives you a better return for your money. But, like any investment, there are pitfalls. It's tempting to jump on the latest stocks or sectors that everyone's talking about, but doing so without any due diligence can be very risky. And as for timing the market, well, that can be tricky, as you can never truly tell if you got in early or late. Just think about those early birds who got in on Amazon or Google. They're probably sipping cocktails on a yacht now, but banking on the next big hit, it's not always a sure shot. Now, you might be wondering, how do I actually see the money? Well, it's all tied to a company's performance. If the stock price goes up from where you bought it, you're onto a winner. But here's the catch. That profit, known as a capital gain, only becomes real when you sell. And if you've held onto that stock for over a year, you might get a tax break. On the other hand, if the stock price takes a nosedive, you're looking at a loss. There's another way to earn from stocks, called dividends. Dividends are what investors get from holding onto a stock. Think of it as your share of the company's profits. Number 2, real estate. While you don't have to be a seasoned investor to succeed in real estate, treating it like a small business can be beneficial. This involves catering to tenants, managing expenses, and staying competitive. The 2008 global financial crisis led to a decline in real estate values worldwide, which might give the impression that it's a risky venture. However, real estate remains a robust long-term investment, often outperforming stocks and bonds. The growth in real estate investments can be attributed to factors like economic development, job creation, and population growth. Urban and suburban areas, being hubs of activity, typically see the most significant appreciation in property values. It's also important to keep in mind that while real estate can be a lucrative investment, the primary purpose of buying a home should be for personal use rather than profit. Living in your own home means you won't earn rental income, but it does save you from spending on rent. Additionally, owning property can provide a sense of security and can be a valuable asset for future financial planning. Number 1, small business. The American dream often conjures up the idea of building a successful business from the ground up. This dream embodies the spirit of entrepreneurship and the potential rewards that come with owning a small business. With the right passion and perseverance, you can embark on your entrepreneurial journey today. Alternatively, if you possess the necessary funds and expertise, you can invest in another entrepreneur's venture and reap financial benefits. However, it's important to understand that these endeavors are not without its challenges. To thrive, one needs a combination of unwavering commitment, proven skills, and sufficient capital. Additionally, a robust network and understanding of the market can further enhance the chances of success in the competitive business landscape. Well, that's it for today. Thank you for watching. Have a great day and see you in the next one.